Hello. Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Craig Martin, and Craig is a certified financial planner. His company, which is a partnership with his wife, is the Family Wealth Consulting Group, and they're fee-only financial planners. Well, I guess fee-based financial planners, whatever. They provide asset management services. He's been doing that for, about 35 years, Craig?
Or more, yes.
Wow.
Yeah.
And he's an author of a book, and I was going to have it here to show you. But anyway, it's called Asset Class Investing. And so you still have a few more of those in the closet?
I still have a few more in my closet, and I forgot to bring one in today.
Okay.
Thanks.
Okay. So if you'd like to get a copy of Craig's book, you're going to see some contact information. If you get in touch with his office, they'd be glad to send you a complimentary copy. And Peggy will be glad to get the room in the closet.
Sure.
Okay. As I said, Craig is a certified financial planner, helps people managing their portfolios and so forth, and in counseling them related to their finances. Today we're going to talk about the role of emotions when investing, and I hope this will be also a stimulant for a discussion with your own financial counselor. And so we'll just take it from here. So Craig, again, thank you for joining me today.
Sure. What we say is that we are fee-only financial planners because I'm not licensed to receive a commission for the sale of a security anymore. I gave that license up. And so our job is to help clients coordinate estate and income tax planning with investments in cash flow.
Okay, good. Thank you.
Yeah.
Craig, I understand a Nobel Prize in economics was awarded related to the role of emotions in investing. Maybe you could tell us a little bit about that.
Sure. Daniel Kahneman won that Nobel Prize 12 years ago now. And he created what has been called behavioral finance out of that Nobel Prize. So prior to 2004, I was studying under a local professor at Santa Clara University in that subject, behavioral finance. But it was not common for me to read it in the public press. So I was quite aware of it. And as soon as Daniel Kahneman won the Nobel Prize, it seems like everybody is now an expert on behavioral finance. What Professor Kahneman did was help us understand how the brain works. He didn't tell us what we say about finance or money. What he said is why we say what we do about finance. So it's a very interesting study of how the brain works. And the bottom line to Professor Kahneman's work is that the human being has survived very successfully because of a very efficient brain.
Yes.
The brain is hardwired to help us survive.
Yes.
And we've only been wearing shoes on pavement for a few thousand years. So for the many hundreds of thousands of years prior to that, our brain helped us survive out in the wilds. Okay, and what we observe today is how the human brain makes decisions from that kind of history, from that kind of training, and we recognize that the brain is hardwired to make certain decisions based upon survival, but not upon good, prudent financial decisions.
Okay. Which may not be good, prudent financial
good,
decisions.
Good, thank you, yes.
Okay.
Yeah.
Okay.
So the success of our brain is noted because we're here.
Yes.
But when you look at how we behave in the financial world, not very good.
Yeah, sometimes things, we make decisions, again, that were against our own interests. So with that, we have our first slide, and so let's talk about that. How does the effect of emotions on investing show up in investment results?
So the slide is very informative. It first came out in the late 80s and was back-page news. It was considered to be a blip in data research. And what it shows is that the average investor is only earning about half of a simple buy and hold of the market. Mm-hmm. It turns out that they did the study for 2 or 3 years in a row and the numbers didn't change. And then they only do it about every 5 years. And the numbers have never changed. It always comes out to about half. The investing public is earning about half of what a buy and hold produces. So a way to describe that is to say that if you were to purchase the S&P 500, mm-hmm. that whatever the S&P 500 earns over your hold period, the average investor is earning about half that. Mm-hmm. In this example, we see that the S&P earned 8.2% for the 20 years from 1993 to 2012.
Yes.
And the average investor earned almost 4%.
Yes.
That is a sad indictment of the human investing patterns. And what it says is that the human brain is telling us when the markets go up, we want to be excited and jump into the markets, but when the markets are going down, we want to jump out.
Okay.
And that takes 2 decisions. That's called market timing, mm-hmm. being in the ups and out of the downs. And you might be lucky and get one of them, when to get out. Mm-hmm. But the chances of you being lucky twice in a row mm-hmm. and knowing when to get back in before it starts back up is very, very difficult. Mm-hmm. The evidence is that that we haven't been able to do that yet as humans. Mm-hmm. So I use the term yet because it could be that someday we'll be able to know the future of stock prices. Today we don't. Mm-hmm. And any action you take trying to manipulate your portfolio based upon what you think stock prices will be ultimately turns into a failure. Mm-hmm. You lose expected return because of those choices.
Okay. So one of the things is, of course, we're making these decisions based as individuals. As I understand it, there are computer models that are out there that are doing some automatic trading.
Yeah.
And so it's the machines that are making the decision, but the fact of the matter is, and they're picking up very, very small changes. But anyway, but it's something that most of us as individuals just aren't really capable of doing.
Well, certainly we can't match the computer with speed or mm-hmm. data simulation. Mm-hmm. However, if those computer models were successful, they would soon own the world. Mm-hmm. That the other way to say that is, if somebody really does know the future of stock prices, we won't read it on the newspaper ranking or rating charts. Mm-hmm. We'll just notice that within a few days, all of us are working for that one person. Okay? Mm-hmm. And that would be true of computer trading also. In other words, if computer trading were successful really, mm-hmm. they'd own the market. But it's not successful. Why? Well, I'm not a computer expert. I can't tell you exactly why. But basically, they're created by humans. Mm-hmm. And what we know about how to analyze the markets, and the computers just analyze it faster than the human being can, mm-hmm. and trade faster than a normal human can. Right. But it doesn't give them the advantage that they're hoping for, which is consistent profits. Okay.
So you don't buy into the algorithm type, which is basically the computerized.
Again, I say not yet.
Not yet. Okay.
No, they're not able to do it yet.
Okay. So let's get into our next slide, and it relates to the cycle of market emotions. And so the question is there a time when investors aren't influenced by their emotions?
No.
Simple.
That's
simple
an easy answer. No, we're humans. We're hardwired with a brain that's a judgment looking to happen. And when we see a column of numbers that are going up, we get excited. And when we see the market going down, we get depressed and anxious and scared. The emotions that I use are greed on the way up and panic on the way down.
Okay.
And it's exemplified by the amount of money that goes into the market when markets have an extended period of positive returns. Hundreds of millions and billions of new dollars race into the market to capture those positive returns. And then when the markets go down in value, those same investors panic and pull themselves out of the market. And the results on the previous slide said they're earning about half the returns of a simple buy and hold. So to earn the positive returns in the marketplace, you need to be willing to suffer the volatility in that marketplace. Because trying to avoid that volatility produces a loss of actual or expected returns.
Okay. And so, again, as human beings, we get excited when we see, returns happening. We see Facebook going up, and we say, so it's going up. So I need to get into it now, and then it may be at that point that it's actually close to a high, and then it's headed the other direction, and then we hope that it's going to recover, and then it may be close to the low, and say, oh, I just got to get out of this thing. I can't stand it any longer.
We can be influenced by the numbers of the market, or we can be influenced by geopolitical events. I wrote a newsletter to my clients, and I said Brexit will probably go down in history as a premier example of behavioral finance in the extreme. Nobody knew for sure what Brexit could or would produce. If you lined up all the pundits talking about Brexit, about half of them were positive because Brexit was going to happen, that if if England left the European Union, great things would happen to England. And the other half of the pundits were exactly the opposite. So which ones were right? Nobody knew.
Nobody still knows.
And the results of the vote were a surprise. Investors don't like unknowns, possible change. And so everybody left the market. And my clients and I recognized that as a buying signal and bought all the way down. So to predict what's going to happen in the future and trade on it produces bad results.
So the old maxim is to buy low and sell high, and we tend to do really exactly the opposite.
Exactly the opposite.
And and nobody quite knows when low and high is part of the problem. So
that's right.
Now, I want to let our viewers know we're recording this on July 26th of 2016. So we've just gone through the last couple of weeks of this scenario of the Great Britain deciding to withdraw from the European Union. But even it looks like it's not going to happen for years and years.
So we still don't know what's going to happen.
They have to sort it out, and so again, we just don't know what the results are going to be long term. All right. So again, when many people, let's just say traditionally, and I think some of this mindset is changing a little bit over the years, but an awful lot of people think that investing is about picking stocks. Okay, you got to get the right stock, and then the right time, for when you buy it and when you sell it, and that's how you make money in the stock market. So what do you think about that? And we do have a slide here again, slide 3 here, so
Sure.
days in and out of the market.
This slide is very instructive of the risks of trying to time the market. The far left column is a buy and hold of the S&P 500, showing a 9.94% return over the period listed here, which is 1970 through the end of 2012. In that time frame, if you'd purchased the S&P 500 and held it in your portfolio, never traded it again, you'd have earned 9.94% over that time frame. But if you missed if on Tuesday you moved out and Wednesday happened to have been the best day in the stock market for that hold period, you'd have only earned 9.66% instead of 9.94. If you missed 5 days, a week of trading days, you're down to 8.8. 15 days, that's 3 weeks trading time. That's 7.5%. Missed 25 of the best single trading days during that hold period, your cumulative return would have been 6.3%. Quickly, you're losing value in your portfolio because you're going out and back in on the wrong days. Okay?
And what we saw, I mean, the thing that sticks in my mind is back, was it, 2008, right? Big market correction, and a lot of people sold after the crash, and they didn't buy in for months or didn't buy back in at all.
Or didn't buy back in at all. That's a real indictment of the investing public. But it's clearly described by Daniel Kahneman. Daniel Kahneman was the Nobel laureate that we spoke about at the beginning of the show. He got hired to go to a broker-dealer whose business it is to pick stocks and time trades, and do an analysis of their trades. They had years and years and years of trading records. What he showed was that they were underperforming a simple buy and hold of the marketplace. Mm-hmm. And when he reported that to those people who were running those portfolios, they did not change their behavior. They justified what they'd done by saying, well, what I did was better than what someone else did, and did not recognize that had they changed their business model and quit trying to pick the stock and time the trade, they would outperform anything they'd ever done in the past. That was a revelation to Dan Kahneman, who when he began his study with these people, asked them, when you sell, you guys are really bright. You use all this data source and get all this information on these stocks. And when you decide that now is the time to buy this stock and sell that stock, who do you think you're buying from and selling to? People less smart than you? Mm-hmm. And for the most part, that's what traders believe. Mm-hmm. It's an interesting model.
Yeah.
They live in a very secluded world where they truly believe they are very smart, and they train themselves to think that they're actually smarter than the rest of the world out there.
Well, when you think about it, I mean, they're getting paid substantial fees to do this. And it is their business. It's supposed to be their training. And so they're going to, I don't know if you say rationalize or however you want to put it, but they're going to believe, they have to believe, that they are bringing value to their clients or customers by doing this, that they're doing a service.
Hiring somebody to come in and tell you that your business model doesn't work is a really tough thing to see. Well, I could understand them not.
But that happens quite often, that you get consultants, and there's the old saying, should you shoot the messenger? Yeah. Like you said, we're human, and we have ways of justifying what we do in our own minds, and especially when we're getting paid huge salaries to do it.
So earlier I mentioned the S&P 500 on this chart that we saw just a moment ago. So for investors looking at this program, what they need to hear, what would help them probably is to hear that you can buy the stock market, a mutual fund representing the entire stock market. The S&P 500 is one of the popular examples of that. A Russell 3000 or Russell 5000 are other examples that could be better in some circumstances. And recently, exchange-traded funds, or ETFs, are very popular because they're traded intraday, which is a bad reason to buy them, but they're inexpensive, like index funds.
Yes, and so and there's a huge variety of those exchange trade funds. So you can find one that is an S&P 500 type fund, or
you can
whatever.
buy an ETF that matches the S&P 500 as well as the Russell 3000 and 5000.
Yeah.
For the most part, ETFs are proxies for index funds.
Okay.
And index funds simply buy all the securities in a asset class.
Okay.
So the S&P buys, surprisingly enough, 500 stocks,
Uh-huh.
representing the large cap growth stocks of America.
Mm-hmm.
Russell 3000 buys 3,000. Russell 5000 buys 5,000.
Okay.
Okay.
Now, we're actually several years after the Great Recession now. We have slide 4 here, which was, again, this was a few years ago, that it's how much stock do investors own, and I believe this was back around through the 2012, well, showing the changes, yeah, from 1959 to 2012 that individual investors owned. And
Good example.
So maybe you can tell us a little bit about this, and do you think that this has changed very much in the last couple of years? The stock market has been doing very well recently, you know, the recovery after this.
If you
Brexit
plot, this chart's very interesting. It is an example of how people move in and out of the stock market based upon how their brain tells them to be fearful or to panic or be greedy.
Yes.
And if we added the last 3 years of trading through December of 2015, it would be even more volatile. So more people moved into the market from 2009 through 2011. More people moved into the market than had ever been into the market, and then moved out in greater quantities. So it is an example of how the human condition, investors suffering the human condition, continue to trade increasingly frequently.
Mm-hmm.
So lots of surveys ask investors, are you a buy and hold kind of investor? And some 70 or 80% of the investors claim that they are buy and hold. But when we look at their actual trading records, they trade about every 2.5 to 2.7 years.
Okay, so yeah, I mean, we're seeing, for example, here in 2006, we had something like 53% held by individual investors, and then by 2012, it's down to 38% or so, and so obviously 80% aren't into it for the long term.
Yeah.
Okay.
Good analysis.
Okay.
So it'd be interesting to note that in our client base, we do buy and hold. We allocate for risk the whole global stock market. We buy and hold. We never trade out of the market. So in 2008, when the market collapsed, went down 40%, our clients went down a little less than that, but it was serious. It was a serious downturn in the market.
Yes.
But nobody sold out. All of our clients stayed in.
Yes.
So today, everybody's earned back and made a profit. We didn't lose anything. We suffered a huge volatility, but because we stayed in the market, all of our clients have now recovered their principal plus profits.
Okay. We only have a minute or so left here, Craig.
Oh, but I have so much more to say.
I know. So maybe you can just get a few sentences out about how working with with a financial planner like yourself, how does that help?
So fee only means that I'm required by law to have a fiduciary responsibility for my clients. That means full disclosure, transparent fees, and any conflicts of interest need to be fully disclosed. I cannot receive a commission for the sale of a security. So our business is advice and counsel. Our business is helping clients make informed decisions, not selling them a product. Our business is about helping clients coordinate estate and income tax planning with investments in cash flow. Our business helps clients build peace of mind. Yeah.
So, and we like to say, again, that you more or less act as a coach. So you're there when we go through what we did for the last couple of weeks to sort of call them and you say, yeah, I know, don't do it, don't jump, and stay the course, and then we can avoid those short-term emotional decisions that
are so painful long term, yes. Interestingly enough, about 25 or 30% of our advice that we do work with clients now is on elder care planning, elder care funding. That's not money management at all. That's on helping my clients manage their parents' affairs.
Okay. Well, Craig, we're all out of time. Thank you for joining me as my guest today. Folks, I hope we've given you something to think about, and maybe you'll think about actually hiring a financial professional to help you, like Craig. So we'll see you next time on Financial Insider Weekly.